Hi, my name is Yasha and I help young men with investments. So today is another video where we are going to analyze stocks because that way I think that I can help you more because whenever you are investing on the stock market or when you are a beginner, your biggest fear is that you will buy terrible stocks with which you will then lose the money, okay? So I want to help you. I want to help you find amazing stocks so that you can then invest into them, okay? Now today we are going to take a look at this company called DHIL Investment Group Incorporated with a stock ticker DHIL, okay? And as always, we are going to use this little Canva presentation that I have right now here. So let's begin, okay? First of all, why should you even listen to me? So as you know, my name is Yasha and I help young men with investments. So when you have more trust for me, I invite you to click the first link in description where I teach you absolutely everything about this, okay? Whoa. Camera is shaking a bit, but I don't know what happened. But still, let's go, okay? Let's analyze Diamond Hill. So whenever you are thinking about investing on the stock market, okay, you should care about the following 6 things when you analyze stocks. So you should care about chart, profit, debt, money on the bank account, value, and price. Now, here are some quick facts about Diamond Hill so that you have better feeling of the company. So it's a company that operates in capital markets. It was founded in 1990, and what they actually do is they are giving investment advice. Okay, for example, you go to them and you say, yeah, I want to buy one house in Brazil. Is that a good idea? Yes or no? And then they tell you whether you should buy or not. It's that simple, okay? Now, here is immediately the first thing that you should pay attention to, okay? Generally, we want to invest in older companies because older companies have been on the market for a much longer time than, for example, one startups, okay? And when you are longer on the market, that means that you most likely survived many stock market crashes, okay? And then if you survived all of those stock market crashes and if you are still here right now at this exact moment, that means the company is good, the management is good, they can handle stressful situations, okay? But if you have one startup that was founded maybe, man, I don't know what's happening with my camera, fuck me. But if you have one startup that was founded maybe last year, the only thing that they experienced so far was that kind of stock market crash that happened last week or 2 weeks ago, okay? And that's it. But if you compare one Coca-Cola company with Diamond Hill, for example, Coca-Cola has been on the market for 200 years, right? So they experienced at least 5 or 6 different stock market crashes. So whenever you analyze a company, the older it is, the safer it is, the better it is, okay? Because we don't want to lose money, we want to make money. Now this company is quite old, okay? They survived maybe dot-com bubble, they survived 2008 stock market crash, and they survived coronavirus, and they most probably also survived that little crash that happened 2 weeks ago, okay? So this company from that perspective seems a good one, okay? Obviously, you want to invest in companies that were founded between 1950 or 60 or let's say 70. Those are the best ones. Those are my top choices. But the older it is, the better, okay? I know that I'm repeating myself way too much. Sorry for that. Now, let's begin with the chart, okay? For chart, we have the following instruction. We have chart has to grow for all 10 years, okay? Because we usually analyze the last 10 years because that gives us a better perspective of the development of the company, okay? Now, what exactly does that mean? Chart has to grow, okay? It's quite obvious, but listen. First of all, I will draw a little exponential line, kinda like that. And then we are going to compare the actual stock price chart, which is this orange line right now here, with this exponentially growing line. And preferably, they should follow each other because preferably we want to invest in companies that are growing, okay? Because if the company is growing, that means more profit, which means more money in our pocket. That's what we want. We want the money. Give us the money, okay? Now, what do we have here? Here you can see that the stock went up a bit and then it crashed massively and then it went up extremely fast again and now it's going down, okay? So from that perspective, if you think about it, does that orange line follow the black line? Of course not. So chart is not good because it's going up and down quite often, but that's not what we want, okay? As I told you, we want kind of steady grow, okay? We want, for example, wait, okay, if this is the chart, what do we want? We want kind of like that, okay? Slowly going up and up and up and up and up and up and up, okay? Now, let's go to profit. So, for profit, we have an instruction that it has to be in plus and it has to grow as well, okay? Now, what exactly does that mean? The very same story as with the chart. So we will draw a little exponential line, kind of like that. And now we are going to see whether the profit follows that line as well. If it does, then the company is growing exponentially, which is what we want to see, okay? Now, what do we have here? So we had quite an amazing growth until 2021, and then the profit fell massively, okay? But now you can see that it's slightly increasing, it's slightly going forward, I mean towards the top. So yeah, I don't know, for me, until 2021, it was a good profit, but now it fell down and it's slowly growing as well. So for me, I think I will mark profit as a not good thing, even though it actually is growing, even though it's constantly in plus, we want to see that, okay? But whenever we analyze stocks, we want to be as harsh as possible when we analyze them, because that will give us that safety, you know, because it's always better to expect a bit worse when you are on the stock market, because then the rewards are much sweeter, okay? And you also are more prepared for potential bad investment, okay? Now we come to the debt, and the instruction tells us that debt has to be low, okay? And preferably it should also decrease through the years. Now, company is the same as you, okay? Think about yourself. Would you like to have more debt or less debt right now? Probably you would want to have less debt, because the more debt you have, the more money you have to make, the more trouble you have, the higher risk you have that you will not be able to pay that debt back, you know. So the more debt you have, generally the stressfuler you are, okay? And the same thing is with the companies. The more debt they have, the more money they have to make, the more trouble they have, the more sleepless nights they have, you know. So debt is generally bad thing, okay? Obviously, on my first link in the description, I teach also about the good debt, but generally for the companies, more debt means usually more trouble, okay? Now, is the debt decreasing? No, quite the opposite. It was first increasing until 2018, but then since that day, it actually is dropping a bit, you know, it's going slowly down. So for me, I think I like that fact, so I will mark debt as a good thing, even though it grew massively. Again, the camera, man. Even though it grew massively, it is decreasing through the years, which is what we want to see, okay? Now let's come to the money, and for the money, we literally measure money that they have on their bank account, okay? For example, you are a young man and you probably have maybe 400, 500 euros that your grandparents gave you for buying the sweets, but now you are thinking about investing, so good decision. And here is the very same money that we analyze, okay? So preferably, DHIL should have more money than the costs. Why is that important? Because whenever something unexpected will happen in the future, which for sure will, okay, they will be able to repay that unexpected event, okay? For example, they are an investment company, they are giving advice. So let's say that you wanted to buy that house in Brazil that we were talking in the introduction. So you want to buy that house, but then the investment was bad, okay? Now, of course, their reputation will go down. Of course, less people will then go to them and ask them for advice. So they will be able to kind of build their reputation back, but in the meantime, they will use the money from the bank account to repay those costs, you know, that they got because the people didn't buy their services, but they still have the costs for electricity, wages, and so on and so on. You know what I mean? So the more money you have on the bank account, the better it is also for yourself. When you are thinking about yourself, the more money you have on your bank account, the easier you sleep, the more relaxed you are, more confident you are. It's easier to go on a nice date with a girl, and then fuck her and so on. You know what I mean? Having cash is the best thing in the world, okay? Cash gives you power. So, do they have positive bank account balance, which means do they have money on the bank account? Do they have more money than the costs? Yes, they do. Look, you are a smart young man. As I always say, they have plus $43 million, which is amazing. They have the money. It's that simple, okay? Now we come to the valuation, and obviously we want to invest in stocks that are undervalued, okay? Now we are measuring valuation by two concepts. The first one is called P/E ratio, and the second one is called intrinsic value, okay? Now, P/E ratio actually uses the data from the company to compare the earnings from that company with its competitors and then also the whole stock market, okay? If P/E ratio is lower than 15, okay, that means that the stock is undervalued because the average P/E ratio of the stock market is 15, okay? So we want to invest in stocks that are undervalued, which means that their P/E ratio is below the stock market, okay? Now, P/E ratio of Diamond Hill is around 10, which is lower than the stock market, which is lower than 15, I wanted to say. So from that perspective, Diamond Hill is undervalued, okay? And now we come to the intrinsic value, and this concept might sound a bit complicated, but it's very simple. So intrinsic value actually tells you the price that Diamond Hill should have at this exact moment based on their financial performance, okay? And then the actual price is the price that they actually have, okay? So basically, intrinsic value is what they should have, but the actual price is what they have. It's that simple. Now, in order for stock to be undervalued, intrinsic value should be higher than the current stock price. Now let's take a look at the example over here. So intrinsic value of Diamond Hill is $196, okay? Let's say 200. So the price that Diamond Hill should have is 200. But the actual price per share is $155, okay? So what does that tell us? That the actual price is by $55 lower than it should have been. Therefore, the Diamond Hill stock is undervalued as well, okay? So, overall, the stock is undervalued, which is an amazing sign. Okay, now we come to the price, and our rule of thumb tells us that price has to be lower than 150 euros because we don't want to invest in expensive stocks, okay? You are a young man, which means that you have a limited budget, okay? And then if you buy one expensive stock that costs 500 euros, then you have only one stock. But if you buy 5 stocks that costs 150 euros each, then even if one stock drops, the others might grow, so you overall have a profit. But if you buy that one stock and then it drops, then you have a loss, you know what I mean? So the cheaper stocks we buy, the better, okay? For me, preferably, I always buy stocks between $50 and $150 or euros, whatever, because those stocks are underpriced. I don't want to spend the money, I want to make the money, okay? And expensive stocks are money pit from my own experience. I want to buy cheap stocks that have potential to grow. It's that simple, okay? Now, is the price below 150? Unfortunately not, by 5 euros higher, so we will still mark this as a no, even though the price is kinda on our limit, okay? And now we come to the final evaluation where we are just going to summarize everything that we found out about the company, okay? So, does the chart grow? No, it doesn't. If you don't believe me, watch the whole video again. Does the profit grow? No, it doesn't. I mean, it goes kinda up and down, but we want that steady growth towards the top, okay? Now, does the debt decrease through the years? Technically no, but It is actually decreasing in the last few years, even though it increased massively. But still, we want to see that. We want to see decreasing debt. So that's a good thing, okay? Do they have money on their bank account? Yes, they do. They have $43 million. Is the Diamond Hill stock undervalued? Yes, it is. And is the price below $150? No, it's not. It's actually 155, okay? Now, should you buy or sell? In my opinion, this is actually quite an interesting stock. So for me, I wouldn't technically buy it, but I would put it on a watch list, okay? And then I would just watch the performance of the company over the next few years, maybe. If you want to have one nice speculation, then okay, you can buy it and then sell it later for higher profit. But for something long term, I think that I would like to wait a bit right now because, as you know, the chart is not growing, the profit is not growing, the price is a bit overpriced, even though it's fine, you know. So I don't know, you know. For me, as I told you, I would keep it on the watch list because I also, if I want to show you here my detailed analysis, so to say, the margins are amazing, you know, they are profitable, they are reinvesting money back into the company, as you can see right now here. They have amazing returns, they have little debt. So for me, I don't know, you know, like it's kind of on the border, you know. For me, I don't think that I am convinced because of the chart and because of the profit, but otherwise it's actually a good company, okay? So for me, as I told you, I would put it on a watch list and then see what happens in the future, okay? Now, if you want to know more about investments, you are invited to click the first link in description where I teach you everything about it. Otherwise, click subscribe, join me on my journey to become a millionaire with investments. Do the hard work and see you on top of the world. Okay.